Welcome, everybody, to Safe Option Strategies, and specifically welcome to our class, Getting Started in the Stock Market, Understanding the Basics. The purpose of this class is for those individuals who might be brand new to the stock market. Maybe you have never traded a stock. You've got your money with a broker, or your money is in an IRA or a 401k that is managed by someone else, and maybe you've never had to trade a stock on your own. The purpose of this class is just to give you a little bit of a feel and a little bit of an introduction into what the stock market is, how it works, and a few things that will help you as you're getting started and learning about how we trade stocks and about how we trade options. At the beginning of every one of our classes, we read through this, and I'm going to do this very quickly so that you can understand and know this. As you go through more and more classes, you may get sick of this, but we're going to read it each and every time. The following presentation is a production of Safe Option Strategies, and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. Any live trades discussed in this or any Safe Option Strategies class are additionally for education purposes only. There is no recommendation, implied or otherwise, to place these trades with real money. Okay, that's the legal speak that we go through every time that our lawyers have us do. Let's dive into the content. This is what we're going to cover in this class, and we're going to cover this. This looks like a long list, but we're going to cover this pretty quickly. What is the U.S. stock market? What is a publicly traded company versus a private company? We'll talk just a little bit about stock exchanges and the general idea of trading stocks. We'll talk to you about what fundamental analysis is and what technical analysis is. These two things have their own separate classes. There is one full-length class on fundamental analysis and two classes on technical analysis to help you get a better feel for that. We're just going to introduce them here. I'm going to talk just a little bit about homework, a little bit about picking a broker, and then I'm going to touch on the big picture of trading. So let's go right through these, and we'll move pretty quick and answer your questions as we go along. What is the U.S. stock market? I took this definition right off of Investopedia, which, by the way, I think is a very good very good website for general definitions. Anything that you wonder about after this class, there's probably lots of definitions and lots of things in the stock market that we're not going to cover specifically in this class, but Investopedia.com is a good source to go for that information. If you look up the definition of the U.S. stock market in Investopedia, it says the stock market refers to the collection of markets and exchanges where regular activities of buying, selling, and issuance of shares of publicly held companies take place. Simply put, in my definition, the stock market generally refers to a variety of exchanges where we can buy and sell stocks. And we can also buy and sell options, ETFs, which we'll talk just briefly about, even though that wasn't one of the bullet points. It's where all the activity takes place. Now, everything we do in the stock market goes through a broker. You and I can't walk into the stock market like we could a grocery store and make the buy or sell of an option. We're not licensed to do that. We can go through a broker who, for a small fee, is going to facilitate the buying and selling of the stocks and the options. And one thing I want you to keep in mind is that stocks are tangible assets. I have a friend who's a realtor. He wrote a little book on selling real estate, and he referred to stocks as fictitious assets, or there was a different term he used for it, but he said it's not a hard asset. And I argued with him. I said it absolutely is a hard asset. When you buy a stock, you own a piece of a company, just like if a group of people went in together to buy a piece of property. I may not be the sole owner of that property, but I own a piece of that property, and I have a say-so in what goes on with that property from that point forward. Stocks are the same way. When we talk about publicly traded companies versus private companies, that does not necessarily mean companies that have stock or companies that don't have stock. Everyone's familiar with Apple. When the company Apple started, you remember the old Apple computer, the very first. This is actually not the picture, but this is a picture of the very first computer I ever remember having in my home growing up as a kid. And some of you remember computers that look like this. This was one, not the original, but one of the very first Apple computers. As Apple got its business up and going, and Apple started creating products, they issued stock. They issued shares of the company to individuals, but it was privately held. None of those shares could be bought or sold in an open market. So even though we refer to some companies are privately held companies and other companies are public, that doesn't mean they issue stock or not. If they're a private held company, it simply means that their stock is only available to certain people and not put on the open market. As Apple developed more products, you remember they added the iPod and then the iPhone, and there were a lot of different versions of the Mac. Then we get to the newer versions of the Mac, the really nice one. This is much more similar to what I'm operating off of now. We've got the laptop computers. These aren't necessarily in the order that these products came out. We have the Apple Watch. Apple became a bigger and bigger company, and well before a lot of these products, they decided to go public. When a company goes public, that's when you and I can start buying and selling their shares. This happens through something called an initial public offering. When a company goes through an initial public offering, they generally start by hiring one or more accounting firms to help value the company. And I'm going to use hypothetical numbers for a moment here, and then I'm going to show you some real numbers. But let's say hypothetically, when Apple first decided that they were going to go public, they hired some big accounting firm, or maybe they hired a few accounting firms, and I'm sure they used their own internal accountants as well. But what Apple had to do was come up with a value of the company. And let's say Apple decided that their company, and through private independent accounting firms, it was decided that Apple's company was worth $100 million. I don't know what they were worth when they went public, but we're just using some numbers that are easy math. And at the same time, Apple gets to decide. This isn't decided by someone else. This isn't decided by you or I. This isn't decided by the stock exchange. This isn't decided by brokers. Apple, and when I say Apple, I mean the CEO, the president, the board of directors, however they've organized their company, they get to decide how many shares they want to divide their company in. So if Apple had $100 million value, and they said, we want to start out with 5 million shares of stock that we are going to make available to the public. Now, they don't necessarily have to make all of those available to the public. They can divide their company into however many shares they want, but they can maintain through the corporate management, the CEO, the board of directors, they can say, okay, here's how much of those 5 million shares we are going to own collectively or individually, and here's how many of those shares we are going to put out in the public exchanges for people like you and I to buy and sell. Well, if they have $100 million valuation to the company, and they're going to issue 5 million shares of stock, their shares of stock would be $20 per share. The day those shares go on sale in the public market, that price could go up dramatically or it could go down dramatically based on the interest or lack of interest of the buyers and sellers. If they put 5 million shares of stock on the public market on the day that it, and we refer to this, the day that the shares go public is often referred to as the IPO, the initial public offering of the stock. There's a lot of work that's done prior to that date when a company decides to go public, but the day it goes public, it's the initial public offering. The amount of people wanting to buy those shares will cause the brokers and the exchanges to raise the price of that stock or lower the price of that stock. So Apple might offer their shares on their IPO date. They might offer their shares at $20 a share, but at the open of the market, you might see it jump instantly to $25 or $30 or $40 a share. Over the next few days, you might see it go down pretty dramatically. You might see the share value disappear. And that's the process of buying and selling stocks. is how this stuff goes up and down. As of the time I put together this presentation, Apple had 4.4 billion shares of stock. 62.4% of those shares are owned by institutions. And all that means is that other large corporations may own shares of Apple, large mutual funds or large companies like Goldman Sachs, like JP Morgan, they might have millions of those shares that they own. And that's considered institutional ownership. And based on the current value of all those shares, Apple is considered worth $1.4 trillion at the time we put together this presentation. 1.65 of those 4.4 billion shares, 1.65 billion of those shares are available for people like you and I. That means that the rest of it, the other, what would that be? 2.8 billion shares. The other 2.8 billion shares are owned by Apple executives or other institutions that are affiliated with them. So this is how we are able to buy and sell shares of Apple. And the same is true. The numbers are obviously different in terms of what the value is and how many shares are outstanding, but this is true of any publicly traded company. So private companies can have stock and can issue stock, but public traded companies go through the IPO process and make those shares available to us. When a lot of different companies are put together into one fund that we can buy a piece of, that is considered a mutual fund or an exchange traded fund. And the only difference between a mutual fund and an exchange traded fund is either one of them is a pool of stocks that are owned collectively in a large fund. Exchange traded means on the market, in the stock market, we can buy or sell shares of that fund. A mutual fund that is not a part of the open exchange, we have to go through the company that holds that mutual fund and that sells us portions of that mutual fund. The companies you're looking at, the logos that you're looking at, are the 30 companies that make up the Dow Jones Industrial Average. We talk all the time in the stock market about the Dow Jones Industrial Average. All it is a collection of these 30 companies. And these are not necessarily the largest companies in the country or in the world. These are not necessarily the most actively traded companies, although all of these are very large companies and all of them are very actively traded. The Dow Jones Industrial 30 companies are intended to give us a sampling of a variety of different industries. You can see if you look at these logos here, Goldman Sachs and JP Morgan. Obviously, the financial industry or the financial sector is represented in the Dow Jones Industrial Average. Procter & Gamble and Pfizer. Both of those companies are in the drug field. United Health, a healthcare organization. Chevron and ExxonMobil represent the energy sector. Home Depot and Walmart, the retail sector. And I'm not going to go through every single one of them, but you can see that there are a lot of different industries and a lot of different sectors of our economy that are represented in the Dow Jones Industrial Average. There are some mutual funds and some exchange traded funds that simply take all of these stocks and put them together into one fund that we can trade on the exchanges. And that's what a mutual fund or an exchange traded fund is. And we can actually buy or sell a share of that fund, which then owns all of those different companies. All right, just for informational purposes, this is not something that is super important that you know, but it's not a bad thing to know. There are three major U.S. exchanges: the U.S. Stock Exchange, the NASDAQ, and the American Stock Exchange. And then there are a handful of additional exchanges, and these are the actual physical locations and the actual organizations that control the buying and selling of all these stocks that we have access to. So it's just something that's good to remember. When we go through a broker, and I'll talk about brokers here in a minute, when we go through a broker, it's not really necessary that we know which one of these exchanges a particular stock is being bought or sold on. Not every single stock that is bought and sold in the stock market is available through the New York Stock Exchange. Not every single one of them is available through the NASDAQ. There is a lot of overlap. There are companies that are traded on the American Stock Exchange, the NASDAQ, and the New York Stock Exchange, maybe as well as some of these other ones. But it at the end of the day, we're going through our broker, and it probably doesn't matter to us most of the time which of these exchanges we go through. When you are buying and selling stocks and options, there are some things that you should always remember. Trading, generally speaking, comes with risk. Now, one of the things that might have attracted you to Safe Option Strategies is our zero risk trading. There are trade strategies that can be set up without any risk for a period of time or with a very controlled amount of risk. But in a broader sense, overall, when you buy and sell stocks and options, there is going to be, in the long run, some risk involved. Now, there are ways that you can roll and create trades with no immediate risk, and you can keep them in a zero risk scenario most of the time, and occasionally with favorable market conditions and favorable trading conditions for that particular company, you can maintain a zero risk setup all the time on some types of trades. But there are other types of trades that are going to have risk, and you need to be aware of that. There are no guarantees ever in the stock market on specific profits or returns on your investment. You can set up a trade where you absolutely know without question what your profit is going to be if that stock moves a certain way, or if the stock doesn't move beyond a certain price up or down. There are ways to calculate and guarantee the amount of profit or loss that you could have, but no one can guarantee you a specific return. It would be the worst thing in the world that I could do to any member of Safe Option Strategies to say, I promise you, you're going to make 70% this year. Because I don't know that. There have been years when I've made well over 70%, and there have been years when I've made a lot less than 70%. I can promise you, as you go through this education and as you learn the strategies that we teach, that you're going to be profitable way more often than not. And I'm willing to guarantee that you will be profitable overall in longer periods of time. That doesn't mean for a short period of time that you might not see your account go backwards just a little bit. That's a natural process and a natural part of the trading, of the whole trading game. And I'll talk a little bit about that at the very end of this presentation. Fear and greed, I believe, are traders' worst enemies. There's nothing worse you can do than get greedy in your trading and start to look for too big of returns too fast. And there's almost the second worst thing you can do is constantly live in fear of what's going to happen next. I'm not going to talk a lot more about that because we'll cover it as we go through specific strategies. We'll talk about the ways to control your fear and to control your greed. I will tell you this. I don't believe there is a way to trade without emotion, and I don't believe you should ever try to trade without emotion. I don't like losing money. And if I ever get to the point where that doesn't bother me, I'm going to lose my edge on the decisions I make in the market. So I don't ever want someone to stop being bothered or upset if they lose money in the market. Don't try and eliminate that motion and become a robot or a computer. I also don't ever want you to not be excited about and celebrate and be happy about profits and returns. And those are emotions that are good. You can't eliminate emotion, nor do I believe you should eliminate emotion in trading, but you've got to learn to control it. When a loss happens and it's a small loss and you've changed it from potentially a large loss to a small loss, that's a small victory in and of itself. And you can control that emotion of getting overly upset or getting angry. When you have a trade that goes great and everything works the way you want it to, you should be happy about it and excited about it. Don't be cocky about it. I love the line from Star Wars, from the original Star Wars movie, the one that started it all back in 1977. And I hope you're a Star Wars fan, or at least you know a little bit about the pop culture reference. But when Luke Skywalker, sitting in the Millennium Falcon, shoots down his first TIE fighter in that little turret gun on the Millennium Falcon, and he says, you know, he shouts for joy, and he gets one, and Han Solo says, "Way to go, kid! Now don't get cocky." I think about that movie line. I can't say it like Harrison Ford says it, but I think about that movie line every time a trade goes my way and I make a nice profit on a trade. I think, way to go. Now, don't get cocky. Control your emotion when you're trading. If you can't be in control, you're going to look to blame other people, and you're going to, I want to be careful how I say this. You're going to trust me and my company to teach you the things that you should do and the things that you shouldn't do. But at the end of the day, when you place a trade with real money, you've got to own up and take responsibility for placing that trade with real money. You've got to know what your maximum possible risk is. You have to know your limitations, and you have to be willing to take responsibility for it. Now, you're putting a lot of trust in me, and I take that very seriously. And I'm going to do everything I can through every trade we send out, through every strategy that we teach. I'm going to do everything I can to lead you in the right way. But take responsibility for what you're doing. All right, let's talk a little bit about doing your homework. I believe that you have to get to know the companies that you're going to trade. There's no question whatsoever that knowledge is power in the stock market. There, I kind of feel like there are basic things you have to understand, and basic things about patterns and trends and information. But one thing I want you to get in the habit of doing is to become a little bit of a news junkie as it relates to stock, and specifically as it relates to the stocks you're trading. Now, you don't have to be an expert on every single company that exists in the market. You don't have to be an expert on it. You don't have to be watching the news 24/7. You don't have to be such an expert on the company that you could go into the board of directors and give a presentation about what that company has done and what they should be doing. That's not what I'm talking about. When I say become a news junkie as it relates to the companies you trade, if you've got open trades on 5 or 6 different companies, take 5 minutes out of your schedule at the end of the day or at the beginning of the day and scan the headlines. See if there is a news story that has just broke about that company that may move the stock up or down. And you'll get better at this at time. Initially, you might read a headline and then look at the way the stock is moving up or down and think, why is this not affecting it more? And other times you'll look and say, why is this headline? This doesn't seem like a big deal. Why is it pushing the stock price down? Why is it pushing the stock price up? You'll get more familiar and get better at that as time goes on. But get in the habit of looking at what is driving the price of stocks. Okay. I'm not going to talk a lot about fundamental analysis and technical analysis because we've got classes that respectively go over this. I will tell you this. You need to understand if a company is in healthy financial situation or not before you trade it. Now, a company that's not in a healthy financial situation may be a good company to trade if you're doing a trade that takes advantage of a downward move in that company. More often than not, we're going to want to be involved in companies that are in good shape financially. You're going to learn to look at things like profit, revenue, debt, what they said on their last earnings report, and generally speaking, what their balance sheet is. Because there's a whole class that delves into this specifically, I'm not going to go into it a lot right now, but understanding the fundamental analysis of a company is not a lot different than understanding your own household budget. It's just on a much larger scale. You can look at your household budget and you can know pretty quickly if the money you have coming in through your job, through your investments, through your retirement is enough to pay all the bills to keep your household running. If you've got enough money to pay for the electricity and pay for the water and pay for the gas and pay for the garbage, and you've covered your mortgage payment and you've covered your insurance, you know what you have left at the end of each month to spend. It's the same with big companies. There's just a few more lines on that balance sheet. There's a few more things that they have to look at. Most households don't have an R&D budget, research and development. Most households don't have a human resources budget. Most households don't have to worry about payroll taxes. So obviously there's things that a company has to keep track of that you and I don't. But the bottom line is there more money coming in than what's going out? And does the debt that's there look manageable? Technical analysis is a little bit different. Technical analysis has more to do with reading charts and understanding what type of trends repeat themselves. All technical data we look at on stocks is historical data. I don't have data for tomorrow. I don't have data for next week or next month or next year. I have data for yesterday. I have data for 10 minutes ago. I have data for last week, last quarter. But chart patterns tend to repeat themselves. They tend to history is never a guarantee of what will happen in the future, but history is sometimes the best thing to help us make educated guesses. In our technical analysis class, we'll talk about chart reading. We'll talk about overloading the circuits, paralysis by analysis. We're going to talk about what things we know and what things we don't know. And I will focus on the fact that every single trade we place, every decision we make in the market is an educated guess. We want our guesses to be as educated as possible. This is a simple picture of a stock chart from Apple, since we've been kind of talking about Apple Incorporated. This particular, well, let's see. Let me do something different here. Okay, sorry about that. You can see that at the time this screenshot was taken, Apple had a really, really nice run to the upside. But when we look at technical charts, we're going to look at things like the relative strength index. We're going to look at things like the moving average convergence divergence. We're going to look at 5 and 20-day moving averages, which are respectively this blue and this red line that go here. These are things that we'll look at as we get into technical analysis. Don't worry right this second if you're new to technical analysis. You'll get better. You'll get good at it, and I'll help you focus on the things that you need to focus on. A handful of websites that will help you with your homework. Stockcharts.com. The screenshot that I just took was from stockcharts.com. In our technical analysis class, I will show you in detail exactly how to set up your stock chart. Stock Charts is a free service, by the way. I'll show you exactly how to set it up so you can make it look exactly like mine if that helps you. You might have a look to it that you want that's a little bit different. Finance.yahoo.com is a website that I use a lot. I mentioned Investopedia earlier. I use CNBC.com and FoxBusiness.com. One thing I would tell you about websites to help you with your homework, I pay a very small subscription to stockcharts.com. I do not recommend that you do that. The only reason I do is because when I am doing a live class for students, I really like to have no ads popping up on the right side of my stockcharts.com webpage. And if you don't pay the small subscription, you'll get those ads. You will, without the subscription, you will not be prevented from doing anything that I'm able to do on stock charts. So it's absolutely unnecessary. If you go to stockcharts.com for the very first time, it is completely unnecessary to pay for any subscription. All the rest of these are free websites. I believe CNBC has a paid premium membership you can get. There's no need to do that. I think Investopedia might have, but I'm not sure. But you don't need to pay anything for any of these websites. There's a variety of other places where you can get information as you're doing your homework. But these are the ones that you'll see me use most of the time. All right, let's talk a little bit about picking a broker if you don't already have one. One thing that's important to know is not every single broker is as familiar with options and spread trading as other brokers. I'll recommend a few in a minute on another page. I'll recommend a handful of brokers that I think are better to work with, but do your research and I'll give you a couple of things to help you with your research. Not every broker will work with you. When I bring on a list of some of the brokers that I like, I will tell you specifically what I like and don't like about some brokers. And one of the things I like most about the broker that I use, and some that come very highly recommended from other students, is how easy they are to work with. When you're choosing a broker, one of the most important factors should be how good do they rate on their customer service. Find a broker whose tools you like and are easy to understand and use. Sometimes having a very user-friendly broker may be as important or more important than their customer service people being the most knowledgeable people in the world. That's just a little cartoon I brought on there for fun. Find a broker you can afford. Brokers have different fees. Brokers have different commissions. Most of them are relatively cheap right now, but make sure you know what you're going to pay per transaction. Your broker is going to make money every time you make a transaction. They have to do that to stay in business. Be aware of that, be prepared for that, and make sure you know what kind of fees you're going to pay to a broker. A few of the brokers that I like, Charles Schwab has a very good stock and option trading platform called Street Smart. They are who I use. I've been with Schwab for a long time. I know their platform very well. I'm not saying that because that's the one you should go to. I'm just telling you that I have more familiarity with them than most other brokers. I know a lot of my students in Safe Option Strategies use Thinkorswim, and I believe they're now owned by TD Ameritrade. They've changed hands a couple of times, but I believe they're owned by TD Ameritrade. Possibly the most robust trading platform in existence is Thinkorswim in terms of the tools they have and the ability. It takes a little time to learn their tools. In some ways, they might be a tiny bit more complicated, but some people like that complexity. And once you learn their tools, they can do a lot. They're a very good platform, and they probably have as good or better customer service than anybody. Interactive Brokers is a great broker for people who are outside of the United States. If you're in Canada, if you're in a handful of European countries, I think Australia, Schwab and Thinkorswim are some of the brokers that you can use. But there are other countries. I have students in Singapore and Japan. I have students in a handful of European countries that don't have access to Schwab. And so Interactive Brokers, I think, is one of the better brokers if you're in a country outside the US or Canada and you find that Schwab doesn't work there or Thinkorswim doesn't work there. They're probably the top rate. Interactive Brokers may be the top rated worldwide broker for people that want to trade the US exchanges but do it from another country. Okay, let's see. E-Trade is pretty good. I've got a good friend who uses E-Trade. He's a registered investment advisor, in a private broker, and he trades his clients' money through E-Trade and has pretty good success with them. Tasty Trades is one that a lot of my students recently have told me about Tasty Trades. I don't know a lot about them other than that they're simple. Meaning they're an easy to use broker platform. I've heard their customer service is pretty good, and I heard their fees are as good or better, meaning less expensive than almost anybody out there. So these are a few that you may want to check, but do your homework on any broker that's out there. And if you come across another broker, oh, I'm sorry. I put on here Tasty Trades, and I was just told by someone that's live in the class that it's actually Tasty Works. I'm not going to go back and re-record this. I'm just going to fix it right here. I'm sorry about that. Tasty Works, not Tasty Trades. Tasty Works. Okay, thank you for that, by the way. All right, let's talk a little bit about the big picture, and then we'll be done. I believe that most people that trade the U.S. stock markets have a really hard time seeing the forest through the trees. Now, a lot of you have heard this idiom, and you're familiar with it. But let me talk to you a little bit about it as it relates to trading. When you open a trade, it suddenly becomes the most important thing to you because you have money invested in that trade. You buy a stock, and suddenly that company and the price of that stock becomes the most important thing in your mind. And what happens is it becomes a big, giant, huge tree that is right in front of you. And it makes it really hard to see around it. It makes it really hard to see above it. And sometimes you lose sight of the big picture because you've got that one tree blocking you. That tree becomes bigger, and it becomes especially difficult if you open a new trade and suddenly it's down, it's negative 2 or 3 or 4%, and you're saying, hey, this is my money. And my money is important to me. It's my future. It's my retirement. It's my lifestyle. One of the things you're going to have to do to become a good trader is learn when your focus needs to be on that big tree right in front of you, and learn when you need to back away and get that bird's eye view and see a larger view of the forest, because sometimes the tree becomes easier to navigate when you can see the rest of the forest. You know, imagine driving a car or driving a bike or a motorcycle or something like that through a forest that doesn't have a perfect road that's paved and perfectly clear cut. You can't ever take your eyes off that next tree in front of you or that next low hanging branch, because you might run into it. But at the same time, you may occasionally need to climb a tree or find a way to get a view from higher ground that shows you the bigger picture. And we'll talk about this off and on as we go through the different strategies that we teach, as we go through the different types of trades you can do. You'll hear me focusing off and on when you've got to focus on the tree in front of you and the branches on that tree, and when you've got to back away a little bit and be able to see the forest through the trees. Homework and discipline are going to be your two best friends when trading. There's no amount of homework you can do that I believe will be overkill. Now, there's the one little exception to that is when we get into our technical analysis class, I'm going to talk to you about paralysis by analysis. You can overanalyze technical charting, but I don't think there's too much homework you can do about the market, about the stocks, and about the news events that are driving the stocks. Become a person who can absorb political, even if you don't like politics. Political news oftentimes drives the markets and drives stock prices, and you need to be at least tuned in enough to it. Doesn't matter what your politics are. It doesn't matter if your politics are perfectly in lockstep with mine or if they're polar opposite of mine. That doesn't matter to me. We can still be friends and we can still both make a lot of money, and that's my goal. But be aware of what type of political events may drive the market. Be aware of what other news events. Be aware of what type of calamities can affect the market. A hurricane, a tornado, a global pandemic. These are things that can affect the market and can affect it in a big way, and you need to be aware of these things. If you're ever in doubt about a trade you want to place, walk away from it. You'll never lose money by walking away from a trade. We're going to teach you over the course of all these classes that you go through, we're going to teach you how to analyze a company, how to analyze a trade from a risk to reward ratio, how to analyze a trade from a good profit to loss ratio. That's kind of the similar thing to risk to reward ratio. We're going to help you determine the probability of a trade being successful and being profitable. We're going to teach you how to adjust a trade, because at any time you could be wrong. You could do all the homework in the world and make the most educated guess anyone could make and have 10 people out of 10 come to the same conclusion that it's a good trade, and then something can happen that's unexpected and turn that trade. We're going to teach you how to manage that and how to adjust that when that happens. But if you have serious doubts about whether it's a good trade or your ability to make an adjustment to that trade is in line, walk away from the trade. You'll never lose money if that happens. I appreciate you taking time to view this presentation. If you have questions about this, I want you to send us emails and ask your questions. And thank you and have a great day. Bye-bye.